Today I'm going to explain why this milestone matters so much, and how to reach it without hype, without gambling, and without doing something stupid along the way. If you're in your 20s living in Europe and you have less than 5,000 saved, this number might feel impossible, but before 20K, money controls you. After 20K, you start controlling money. Emergencies stop feeling like disasters. Decisions stop being based on fear, and investing stops feeling like gambling. Before 20,000 euros, you're in what I call the gravity zone, the hardest phase of building wealth. Not because the strategy is complex, but because the results feel painfully slow. Imagine you invest 500 euros per month at an 8% annual return. How long to reach 20,000 euros? About 3 years. 3 years of discipline. 3 years of consistency. 3 years where progress feels almost flat. That's what most people underestimate. Building your first 20,000 euros is like pushing a heavy stone uphill. You're doing almost all the work. Gravity is against you. Now here's the shift. Once you hit 20,000 euros, how long to reach 40,000 euros? Not 3 more years. Closer to 2. Because now your capital works with you. At 20,000 euros, 8% generates 1,600 euros per year, about 133 euros per month. Your real monthly contribution is no longer 500 euros. It's 633 euros. And that compounds. This is when the slope starts to flatten. You're still pushing, but it's lighter. Eventually, the same force that slowed you down starts accelerating you. The second 20K euros comes faster than the first. The third comes even faster. Most people quit before they reach this point. The gravity zone isn't permanent. It's a threshold, and once you cross it, the rules change. Before 20,000 euros, your financial life is structurally fragile. One unexpected event, car repair, medical bill, delayed paycheck, can push you from investing mode into survival mode. When your margin is small, every shock feels amplified. You pay more because you have less liquidity. You rely on credit. You incur fees. You delay decisions. This is the poverty tax. It creates a cycle. You don't invest because you don't feel safe. You don't feel safe because you don't have capital. And you don't build capital because you're constantly fixing emergencies. Your life becomes reactive instead of strategic. There's also a psychological cost. When you lack margin, your brain shifts to short-term thinking. You stop asking, what's the best decision for the next 5 years? And start asking, how do I fix this right now? Urgency replaces strategy. Crossing 20,000 euros doesn't make you rich, but it changes your stability. It gives breathing room. It reduces the chance that one bad event derails everything. It gives you optionality, and optionality is financial strength. Below 20K, you're exposed. Around 20K, you start building resilience. And resilience is what finally allows long-term investing to work. There's a deeper shift that happens around 20,000 euros, and it has nothing to do with returns. When you're financially fragile, part of your brain is constantly scanning for danger. Even if nothing dramatic is happening, your stress baseline is higher. Your nervous system is alert. That background pressure consumes mental bandwidth. Research shows that financial scarcity reduces effective decision-making, not because people are less intelligent, but because part of their cognitive capacity is occupied with short-term risk assessment. When money feels tight, your brain reallocates energy toward protection instead of planning. Once you build a meaningful buffer, and for many people that starts around 20,000 euros, that pressure decreases. You sleep better, react less emotionally, think with more clarity, make decisions with longer time horizons, lower stress improves judgment, and better judgment compounds, just like money does. The difference isn't visible in your portfolio statement. It's visible in how you operate. There's a real shift that happens around 20,000 euros, and it has nothing to do with motivation. It has to do with scale. The first 20,000 euros takes the longest. You're building from zero. Every euro comes from effort, discipline, and patience. Returns barely move the needle. But once you cross that level, something changes. Not because you changed your strategy, not because you suddenly became smarter, but because now your capital is helping you. At 8% per year, 10,000 euros generates 800 euros. Nice, but not life-changing. At 20,000 euros, that's 1,600 euros per year. At 100,000 euros, that's 8,000 euros per year. Now the numbers start to matter. The second 20,000 euros usually comes faster than the first, because contributions and returns are stacking together. The strategy doesn't change. The discipline doesn't change. The assets don't change. Only the scale changes, and scale changes everything. The hardest work is at the beginning. Once momentum builds, progress becomes progressively easier. Crossing 20,000 euros isn't just a financial milestone, it's a structural and psychological shift. You stop thinking like someone trying to start investing. You start operating like an investor. To get here, you had to say no many times. You built discipline. You proved to yourself that you can delay gratification. That changes how you see yourself. This is the first moment where you trust yourself financially. Not because of the money itself, but because of the habits it required. And that identity shift changes how you operate. At this level, you optimize tax-efficient accounts. You diversify properly instead of owning just one ETF. You gain access to better instruments with minimum requirements. You reduce unnecessary banking and FX fees. You buy in proper allocations instead of fragmented small orders. For Europe specifically, this means using UCITS ETFs efficiently, optimizing withholding taxes, reducing currency conversion costs. At this stage, you're no longer experimenting. You're structuring. Money didn't just grow, you did. Crossing 20,000 euros changes something subtle but powerful, your ability to say no. When you have a financial runway, even 6 to 12 months of expenses, you're no longer negotiating from fear. You're negotiating from stability. You can walk away from a bad job offer. You can refuse unfair conditions. You can take calculated risks instead of desperate ones. This is what some people call walking away money. It's not about being rich, it's about having options. When you don't depend on your next paycheck to survive, your posture changes, your confidence changes, your decisions improve. 20,000 euros doesn't buy things. It buys optionality, and optionality increases leverage. One of the biggest dangers after reaching 20,000 euros isn't market risk. It's psychological risk. You hit a milestone, you feel proud, you feel ahead, and your brain immediately looks for a reward. That's where people sabotage themselves. They upgrade the car too early. They increase lifestyle before increasing income. They celebrate as if the game is over when it has barely started. 20,000 is not financial freedom. It's financial momentum. If you dramatically increase your expenses at this stage, you reset the difficulty. You turn progress into pressure. This is how people kill the golden goose. Instead of letting capital compound, they consume the very asset that was starting to work for them. The first 20K should increase discipline, not lifestyle. Because if you protect it, it becomes 40K. If you reward yourself too aggressively, it becomes 0. The real flex at 20K is not upgrading your life. It's staying the same while your capital grows. Leverage feels like acceleration. Most of the time, it's just risk in disguise. If you borrow money to invest before you have real capital, you're not multiplying returns, you're multiplying pressure. Investing with debt. Options without understanding risk. Futures for quick gains. Highly speculative crypto bets. Leverage only works when you can survive being wrong. If one mistake can wipe you out, it's not leverage. It's gambling. Build capital first, use leverage later. Buying a house too early feels like success, but financially it can trap you. It drains liquidity. It kills flexibility. It reduces your power to walk away. It creates fixed pressure, and here's what people don't talk about. If a life-changing opportunity appears in another country, moving becomes 10x harder. You're not just deciding about a job. You're deciding about selling a house, renting it, managing it, or emotionally letting go. There's psychological attachment. You become anchored to a place. Rent is predictable. You know what you pay every month. Owning is not. There are repairs. There are upgrades. There's always something, a new sofa, a broken pipe, maintenance, taxes. A house looks like stability. But early on, it often reduces optionality. Owning property is not financial maturity. Mobility is. If your first big move locks you in, you're building roots before building leverage. Your first 20,000 isn't about maximizing returns. It's about building stability and optionality. Suggested structure: 5 to 10K emergency fund, your bulletproof layer. 10 to 15K global index ETFs. 1K invest in yourself, high leverage skills, with the goal of increasing your value and charge more for your work. The goal is simple: security first, growth second, upside third. You can adapt it like this: 3 to 6 months of expenses in cash, 1 accumulating global ETF, UCITS, 1 monetizable skill. At 20K, you're not trying to get rich. You're trying to become anti-fragile. Reaching your first 20K is not about luck or timing. It is about structure. There are only 2 levers that matter: defense and attack. On the defensive side, your goal is to stop financial leaks and create stability. Before trying to grow your money, you need to protect it. That means track your expenses for 30 days so you know exactly where your money goes. Calculate your real net worth, not just your bank balance. Automate your investments the moment your salary arrives so decisions are not emotional. Clarity removes anxiety. Automation removes impulsive behavior. Most people do not fail because they earn too little. They fail because they never gained control over what they already have. Once your base is stable, you move to the attack phase. Saving alone will not get you to 20K quickly, increasing your earning power will. That means asking for a raise if your performance justifies it, changing jobs if your growth is capped, building a second income stream with monetizable skills. You do not reach 20K by obsessing over small expenses forever. You reach it by expanding your capacity to generate income. At the end of the day, this is not about motivation. It is about clarity and system. When you know your numbers and you build a simple structure that runs automatically, progress stops feeling random and starts becoming predictable. And that is exactly the promise of this channel, helping you make your first financial decisions without screwing them up. The real objective is not money. It's independence. It's having options. It's the ability to walk away from situations that no longer serve you, like a bad job, a toxic environment, a rushed decision. Capital doesn't just increase your net worth, it increases your negotiating power. It reduces emotional pressure. It attracts better opportunities because you're no longer desperate. Wealth is not about status. It's about optionality. Instead of asking, how do I reach 20,000 euros? Ask a better question. What guarantees I will never reach it? Spending more than you earn. Carrying expensive debt. Chasing quick wins. Comparing yourself to others. Refusing to learn. Most financial failure is not caused by lack of intelligence. It's caused by repeated small mistakes. Avoid the obvious traps long enough and progress becomes almost inevitable. Sometimes the smartest strategy is not about doing more. It's about removing what sabotages you.